Hi friend, and thanks for joining me for another chat on FIRE. So think of stocks like business partnerships. Let's say you have a friend named Elon who says to you, hey, I have this great idea for a company. It's called Tesla. We're gonna make an electric sports car based on the Lotus Elise. So it's gonna be fast, it's gonna be instantly fast, and have good range too. So you're like, dang, that's insane, Elon. So you push the invest button and you're like, you son of a gun, sign me up for $10,000. So why does your friend Elon, a multimillionaire, even need your money? Because he's like, hey girl, I have millions of dollars, but I can't do this alone. We need much more than what I have. We need money to hire talent, to build factories, to source parts, to get this launched to the moon. Let's go in it together. If this car becomes popular enough, we could make more cars. We can't get this car company off the ground if we don't have money in the first place to hire the engineers to design this, the auto workers to build this, and the marketers to promote this ultra cool car. Elon is like, I could just sell some bonds to raise money, but just in case in the future people are interested in our cars, I don't want to be on the hook for some loans that I can't pay off. Let's just go in together on this venture, and anyone who believes in the vision can profit with me. If the company does well, everyone gets a share in the success. The company doesn't do well, everyone has some skin in the game and loses some too. But by not selling stock, the company cannot get off the ground and cannot exist in the first place. Again, partnership. Elon looks at you and says, ride together, die together. Bad boys and bad girls for life. Elon slaps a few $1 million on the table, and you, along with a million other people, also go in a little bit, and bam, Tesla's off the ground. Company makes a profit, up goes the stock. Some Teslas start burning randomly on the freeway for some unknown reason. Some start losing faith in the company, and your investment starts tanking down in value. People start selling their shares in the company and exit, so the price starts dropping. But then a new model comes out, a whole bunch of reservations get made, so the stock value goes up. Now, generally, good news and bad news for a company, whether external, like an amazing economy where unemployment is low, or a virus lockdown, or something internal like development of cool products, bad products. These are all things that can affect stock prices. But it isn't perfect. It is incredibly difficult, if not impossible, to predict whether one specific company's stock price will go up or go down, even if you know all of these factors. And even more difficult, if not impossible, to say is when it will go up or down. Remember, if you try this dangerous game of trying to time when a peak and a trough will occur, you have to be right twice. You have to be right when you enter, you have to be right when you exit. So the advice from most savvy investors is do not try to time your entrance and exit. If you like the company, just invest in it. In addition, to zoom out further, it is nearly impossible to pick which stocks of any specific companies will go up or down in value over time. For every early 2000s Amazon that you could have picked, you could have just as easily picked webvan.com, which was a blazing fast grocery delivering service valued at over $1 billion at one point during the dot-com boom and bust, where frenzied investors thought that as long as Webvan got to do this service first, they would dominate the market. For every Google you could have picked, you could have also picked Yahoo, which was huge at one point and failed miserably. Good thing is that there is a much safer way to invest in hundreds or thousands of companies at once. And again, that is with index funds or exchange traded funds, ETFs. Instead of all your money going towards supporting one company, your money is divided into many companies so that if one company goes bust or another company goes to the moon, your money is not swinging wildly. When you invest in ETFs, your money is helping to grow a bunch of companies. As long as you believe that over the long haul that the economy will continue to grow, that new products will continue to be made, and that more jobs will be available so people can make more money to buy more things or services, you can keep your money in ETFs. Remember though, ETFs are not just a reflection of what is happening today. It's a reflection of today and the future. The prices of ETFs or any stocks already have factored in what folks will think will happen in the future. This could partially explain why we saw such an insanely fast recovery in April 2020, when people realized that the virus overall was not affecting the productive workforce over the long run. Well, that and very low savings account interest rates leading people to borrow more money to buy things, or leading people to seek more high yield investments, these are all factors. Also, many people had more money to invest due to not having elsewhere to spend their money, like going out to eat or traveling and a million other factors. Okay, time for a fun fact. Some of the most successful investors have lost their usernames and passwords to their retirement accounts, but had already set up automatic deposits and automatic investments into large cap index funds or total stock market index funds. Their success stems from the fact that they have taken the human emotion completely out of investing. So the answer to the market volatility that we are experiencing right now, rippling from the Evergrande debt crisis or potential virus variants, is this. Stay seated with your seatbelts fastened. You're on an airplane, there's turbulence. Just like a passenger on an airplane cannot tell when the airplane might suddenly take a dip, none of us can tell when the stock market will drop, or even if it will drop. This volatility could be over soon, could go on for a while, nobody knows. Can this Evergrande catastrophe affect your net worth or your retirement accounts in the short term? Yeah, it possibly can. Will it affect your money in the long run of years or decades down the line when you actually will be withdrawing from your accounts? Chances are very unlikely. Should you get out of the market now and get back when things calm down? The answer is this. Nobody knows when things might calm down. Nobody knows if in the coming weeks the market will be up or down. So stay buckled in your seats, don't overthink it, and keep investing. What if it goes up and you miss those gains? There's one lesson to learn from Evergrande though. No matter how big a company is or how successful it may seem, do not put all your eggs in one basket. Do not have all your money in one company or even one sector of the economy. Spread your risk, and in case I need to say it again, buy ETFs. Which ETF? I like SCHB or VTI. They have over 2,000 to almost 4,000 companies included. One more lesson. If you cannot imagine holding onto your ETFs for at least 7 to 10 years, I don't want you investing for more than 7 to 10 seconds. As an example, there was a 30% drop in March 2020 and it took a few months for it to rebound. Sometimes it can take years for a rebound to happen. If you're scared of potential drops, and it's totally reasonable when you're first starting off to be scared, I want you to learn more about stocks first before you go in. I want you to understand a little more about why these things happen so that you'll be more comfortable when it happens, and it will happen again. When you own stocks, you're an investor in a business. You're no longer a worker that gets paid a guaranteed small fixed salary. When businesses do well, you will do well. When business is slow, you may lose some money. It would almost be impossible for you to lose all your money, all your initial investment, unless the world seriously implodes on itself. Take solace in knowing that every single time that it has ever happened in history, from the Great Depression to the dot-com bust to the housing crisis of 2008 to COVID March 2020, we have come back much, much stronger every time. It doesn't mean that we will definitely rebound if it happens again in the future, but there has never been a time in all of history where we haven't come back better than before. If you believe that people will keep innovating, that new products will continue to be made, that there will continue to be new iPhones, that people will keep watching Disney movies or buy lumber from Home Depot, then investing in exchange-traded funds could be right for you. And that's all for today, my friends. Feel free to subscribe if you want to learn more. Share this video with a friend if you like today's episode. Happy investing, and let's get financially savvy together.